RMD. What happens if you don't take your RMD? It could be serious. Required minimum distributions. Beginning in 2023, the Secure 2.0 Act raised the age that you must begin taking RMDs to age 73. RMDs affect all pre-tax qualified retirement accounts such as IRAs, SEP IRAs, 401ks, 403bs, and 457 plans. The calculation of your RMD is based on the value of all qualified accounts on December 31st of the previous year. Roth IRAs are excluded from the calculation because they are not subject to RMDs during the life of the account owner or their surviving spouse. Once we have the total value of all accounts, we need to go to the IRS Uniform Lifetime Table 3, which applies to you if you are married and your spouse is less than 10 years younger than you, or you are single, or your spouse is not your primary beneficiary. There's a different table if your spouse beneficiary is more than 10 years younger. When we look at the table, we look for the age the account owners will turn this calendar year. For each year, the IRS has decided a distribution period that is represented in years. If we divide 100 by the number of distribution periods, we find the percentage of the account value that needs to come out to satisfy the RMD for this calendar year. When you first take your RMD, it will be a smaller percentage. Each year, the percentage increases with your age because the distribution period gets shorter on the Uniform Lifetime Table. Let's look at an example of how the RMD is calculated for Bruce. This is Bruce. He turned 75 years old this year and has qualified accounts that he needs to take an RMD from. He's married to Cindy, who's 68 years old and is primary beneficiary on his accounts. On December 31st of last year, he had a total of $100,000 in all his qualified accounts. Bruce has an IRA with $75,000 in it and a 401k with $25,000 in it for a total of $100,000 in qualified account balances. Let's calculate the amount of RMDs that Bruce needs to take. Okay, so he has $100,000 and he divides that by 24.6 years, and that equals $4,070. Bruce decides to take the full RMD amount out of his 401k plan this year. Bruce talked to his tax advisor and got advice before he took the withdrawal. So he instructed the plan to withhold 15% for federal taxes to be paid on the distribution and 5% for state. When he actually takes the money out, this is what happens. $610.50 goes directly to the IRS, $203.50 goes to the state, and the remaining $3,256 can go directly to his bank account or his non-qualified investment account. Just like Bruce, you may have more than one IRA or 401k. In that case, you may take your total combined RMD amount out of just one account if you would like, or you can take out the required amount from each account. What you do with your RMD is up to you. You don't have to spend it, but you do have to pay taxes on it. RMDs are taxed as ordinary income. Now you must remember to take your RMD and the correct amount, because if you don't take your full required amount each year, the IRS may penalize you up to 50% of the amount you failed to withdraw. Reach out to us at Genesis for individual guidance on required minimum distributions.